Have you ever wondered how the government makes sure you don't live off tax-deferred retirement savings forever? Well, they have a little something called required minimum distributions, or RMDs for short, and trust me, understanding them is crucial for maximizing your retirement income. So that's what we're going to talk about today on the show.
Welcome to the Ask Ralph podcast. We're listening to an experienced financial professional with over 30 years of experience can help you make sense of confusing questions, current headlines, and industry trends about taxes, small business, financial decision-making, investment strategies, and even the art of proper budgeting. Ask Ralph makes the complex simple by sharing his real-world knowledge from a Christian perspective with all things financial. Now here's your host, Ralph Estep Jr.
Welcome back, everyone, to the show where we tackle your financial questions from a faith-based perspective. I'm thrilled you joined me today for another insightful episode of Tax Talk Thursday. Yesterday, we dove deep into the fascinating world of artificial intelligence, or AI, and its growing role in lending decisions. It was truly a thought-provoking discussion, and I encourage you to check it out if you missed it. Now, tomorrow, we're switching gears completely and tackling a topic that's near and dear to many parents' hearts. And that's how to encourage adult children to spread their wings and leave the nest. We're going to explore 10 practical and compassionate strategies that can help make this transition smoother for everybody involved. That's going to be a non-miss episode. But for now, let's dive into the world of required minimum distributions. As the good book reminds us in Proverbs chapter 21, verse 5, the plans of the diligent lead surely to abundance, but everyone who is hasty comes only to poverty. Just like diligent planning is crucial for a fruitful life, understanding RMDs is essential for a financially secure retirement, and that's what we all want. So what exactly are these RMDs I keep mentioning? Well, in a nutshell, they're the minimum amount of money you're required to withdraw from your tax-deferred retirement accounts annually once you reach a certain age. This applies to traditional IRAs, 401ks, 403bs, and other similar plans. Now, you might be wondering, why does the government care, Ralph, if I withdraw money from my own retirement account? Well, remember that beautiful thing called tax deferral. That's when you contribute to these accounts, you typically get a tax deduction, meaning you don't pay taxes on that money up front. The government essentially gives you a loan, letting your money grow tax-free for years with the understanding that they'll eventually get their cut. They always want to get their cut, friends. That's where RMDs come in. Once you reach a certain age, currently that age is 73, the government wants their share of that pie. They figure you've enjoyed tax-deferred growth long enough, and it's time to start paying taxes on those distributions. Now, here's where things can get really interesting. The amount you're required to withdraw each year isn't a fixed number. A lot of people are surprised by that. It's calculated based on your account balance at the end of the previous year and your life expectancy as determined by the IRS life expectancy tables. For example, let's say you have $500,000 in your traditional IRA at age 73. According to the IRS tables, your life expectancy might be 25.6 years. Not sure how you live a 0.6 years, but anyway, for the discussion, we'll keep going. So to calculate your RMD, you'd simply divide your account balance by your life expectancy, which in this case would be $500,000 divided by 25.6. That equals $19,531.25, if you're keeping up with the math. This means you would need to withdraw at least that amount from your IRA by December 31st of that year to avoid hefty penalties. Now, I know what you might be thinking. Ralph, I don't need to withdraw that much money each year. I'm living comfortably on my other savings. And that's perfectly fine. However, the IRS doesn't care about your personal situation. They have rules. And guess what, folks? You need to follow them. Failing to take your RMD by their deadline can result in a whopping, now listen to me, 50% penalty on the amount not withdrawn. That's right. Half of your hard-earned money could vanish into thin air simply because you didn't follow the rules. Unfortunately, I've seen this in my own practice. Now let's talk about some recent developments in the world of RMDs. As you know, tax laws are constantly changing, and it's crucial to stay informed. One significant change came with the Secure Act 2.0, which was signed into law in December of 2022. This act made some positive changes. It pushed back the age at which you must begin taking RMDs. Before that, the age was 72. Now, if you turn 72 in 2022 or earlier, You got to start taking RMDs by April 1st of the year after you turn 73. If you turn 73 in 2023 or later, you must start taking RMDs April 1st after you turn 74. Certainly a trend here. This change gives your money a bit more time to grow tax deferred, which is always a good thing. However, it's essential to remember that this delay only applies to the first RMD. After that, you're going to need to take your annual distributions by December 31st of each year. Now let's shift gears and discuss some effective strategies for maintaining your RMDs in retirement. Remember, these distributions are taxable income, so it's crucial to plan strategically to minimize your tax burden. So let's start off with strategy number 1, and that's this: withdraw more than minimum. While it might seem counterintuitive, withdrawing more than your RMD can be a savvy move, especially if you anticipate being in a higher tax bracket later in retirement. By withdrawing more in your early retirement years, you could potentially lower your taxable income and thereby reduce your overall tax liability. Let's look at strategy number 2, and that's consider qualified charitable distributions. Now, the short name for these are called QCDs. So if you're a charitably inclined person, QCDs can be a fantastic way to manage your RMDs while simultaneously supporting worthy causes you believe in. With a QCD, let me explain to you how this works. You can directly transfer up to $100,000 from your IRA to a qualified charity without recognizing that distribution as income on your own tax return. Not only does this strategy reduce your taxable income, but it can also lower your adjusted gross income, or what we in the trade call AGI. And this can have a ripple effect on other taxable benefits, such as reducing your Medicare premiums. There's those things called IRMA adjustments also. So if we can bring that AGI down, that's definitely a positive. Let's look at strategy number 3, and that's explore Roth conversions. Converting a portion of your traditional IRA to a Roth IRA can be a strategic move, especially if you anticipate being in a higher tax bracket later in retirement. While you'll have to pay taxes on the amount you convert, unfortunately, I can't get around that, your money will then grow tax-free in the Roth IRA, and then those qualified distributions in retirement are completely tax-free. But again, you want to talk to a professional because there are some nuances to that. This strategy can be particularly beneficial if you have a long time horizon before you need to start taking those RMDs. Well, let's look at strategy number 4, and that's this. You can work with a financial advisor. And listen, folks, I would highly recommend you do this. Navigating the complexities of RMDs can be challenging. Trust me, these are not simple, especially with ever-changing tax laws. Seeking guidance from a qualified financial advisor who not only understands your unique financial situation, but can also help you with goals, these things are invaluable. They can help you develop a personalized RMD strategy that aligns with your overall retirement plan. So there you have it, folks. The ins and outs of required minimum distributions. Remember, these distributions are a fact of life for those with deferred retirement accounts. It's sort of like they say there's 2 certainties in life, death and taxes. And taxing these deferred accounts is one of them. However, and this is the honest-to-God truth, with careful planning and strategic decision-making, you can minimize their impact on your retirement income and ensure your savings last for a lifetime. As we wrap up today's episode, I want to leave you with a powerful reminder from Proverbs chapter 13, verse 11. And it says this: wealth gained hastily will dwindle, but whoever gathers little by little will increase it. Just as building wealth takes time and discipline, managing your RMDs effectively requires a long-term perspective and a commitment to making informed decisions. Don't let fear or procrastination lead to costly mistakes. Unfortunately, I see that time and time again. You got to take charge of your financial future today by understanding your RMD obligations and exploring effective strategies as we discussed. And remember, if you're feeling overwhelmed or unsure about the best course of action, don't hesitate to reach out to a trusted financial advisor. They can provide personalized guidance and support to help you navigate the complexities of retirement planning. Before we sign off, I want to invite you to visit our website. That's at AskRalphPodcast.com. There you'll find a wealth of resources to help you on your financial journey. There's blog posts, videos, and past episodes of this podcast. And while you're there, be sure to join our email list to stay up to date with the latest content and exclusive offers for our listeners. And if you found value in today's episode, I'd be grateful if you could share it with others who might benefit from this information. The truth is, folks, together we can help more people experience the financial freedom and peace that comes from aligning our finances with our faith. As always, stay financially savvy, and God bless you. Until next time, this is Ralph reminding you that with God's guidance and wise stewardship, you can master your finances and live the abundant life He has planned for you.
Thank you for joining us on the Ask Ralph podcast. And with a simple click to subscribe, we'll invite you back to our next episode. And remember, financial issues don't have to be complicated. Just ask Ralph. The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media, Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.